Palantir has been the topic of many conversations lately, and in today's video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile and rather on a downward trend at the moment, we should be mindful about which positions to pick, as well as their individual timing and exposure. Before today's video begins, if you'd like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, the price action of Palantir has brought the stock to around $7.44 before stabilizing around $8.60. Recently, Palantir has had a decent run in terms of price action. The stock has touched a relative bottom on May 11th, and since then, it has been able to bounce back higher. I believe that additional upward momentum will be felt once the price goes above $10, as it would be a key psychological support for the company. In the long run, I think that the initial hype has definitely settled, and investors across the board are now looking at the company with a fresh perspective by trying to obtain the maximum of potential value for their investment. One thing about Palantir is that investors are now ready for the long haul for the most part, and that the company will have enough room to breathe and to develop its potentials. Recently, there was an article about Microsoft entering into the corporate data analytics field with their Microsoft Intelligence Data Platform to help solving the fragmented dataset issue in many organizations and to help optimizing the operations. It is de facto putting together a competitor to Palantir. Now, to be honest, I don't think that this new platform is going to create that much volatilities for Palantir in the short term or even the medium term. Tech giants have long played with the notion of data analytics and the potential value we can get out of it. The question is whether there's enough demand for this kind of service and if the platform suits the company's needs. Even before these announcements, there are already many other companies proposing similar services and platforms than what Palantir is proposing, but that doesn't mean that it would stop getting clients. And at the end of the day, Palantir still does have many advantages over other companies. This is a bit like Amazon Web Services and its competitors. There are quite a few major online service providers with similar platforms and capabilities, and yet it didn't stop Amazon from investing and developing further this sector into one of the biggest players in the field. Now, let's take a look at the technicals of the stock. The trading volume of Palantir has recently been 31 million shares, compared to the average volume of 54 million shares. Over the previous 52-week period, its price fluctuated between $6.44 and $29.29. The trading volume is a metric that can tell you how many shares are being exchanged and whether there's a lot of activities and attention on the stock. It often gives you a first idea on the popularity of the company. When we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its current trend or to break through the resistance levels. Even when the current volume is lower than the average, it's still an interesting information to have because it may tell us whether the trend will reverse soon. The market cap of Palantir is currently at $18 million. Versus the enterprise value of $26 million. Put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost of the company that has already paid for its assets minus the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be intangible, meaning they are not items or inventory that a company can use to generate income, but rather secondary items that are tokens that can guarantee the company's future potentials. For example, great management, pledges for major contracts, blueprints, and schematics. For startups, most of their valuations are based on those intangibles, which can be valued in favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that the company is trading at a discount. It's only trading below its book value, but that doesn't mean the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and that it has deflated itself ever since. When we compare the current price to the historical price fluctuations, the stock is 35% higher than the 1-month low, 35% higher than the 12-week low, and 35% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 71% versus a historical volatility of 108%. The put-call volume ratio is currently at 0.98. It's normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 60,000 contracts a day versus the 30-day average of 80,000. In terms of open interest, the most recent volume of open interest is 3.1 thousand contracts versus the 30-day average of 3.4 thousand contracts. The options contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likely scenario based on the opposite of what the current ratio is. If there are a lot of put options, then there may be possible uptrends on the move, or that the reversal may happen if there's a lot of call options. The reasoning behind this theory is actually quite simple. Most options expire worthless. In terms of shareholder structure, institutional shareholders own about 33% of the outstanding shares. The biggest shareholders include BlackRock, Vanguard, and State Street. It is relevant to understand the shareholder composition of a company, as this helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retails, it may be a sign that the stock lacks the depth to justify long-term holding. Typically, there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, since many titles are mostly held by retail investors and not institutional ones, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the price falls lower. Sometimes there are significant short interest in the total volume. That can be a sign of something organized going on, like what happened with GameStop and AMC. The current short interest is just 8% of the total float, with 50% of it coming out of the dark pools. If the short interest is about 15% of the total volume, with a significant chunk of it outside of the exchange, this may suggest that there are institutional positions taken to short the stock. Overall, my recommendation on Palantir is to keep dollar averaging down, while keeping in mind that the current downside pressure will be reflected in the long run, and that good buying opportunities may show up later as well. I would recommend to commit between 3 to 5% of your portfolio, and would further like to recommend an allocation in batches of 10 or 20% at a time to benefit from further retracements if they ever happen. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, If your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.